Whenever a central bank makes a decision on interest rates, the headline number almost never tells you the full story. And the South African Reserve Bank just made a choice that seems pretty straightforward. But trust me, it reveals this high-stakes game being played for global trust. So let's break down what's really going on here. All right, so here's the number, 8.25%. That's the key interest rate. And the South African Reserve Bank, or the SARB, as you'll hear it called, decided to just leave it there. No change. At first glance, you might think, okay, nothing to see here. But what if that's the whole point? And that really gets to the heart of what we're talking about today. Was this just a simple pause, a let's wait and see moment? Or was it something else entirely? A very deliberate, very strategic power move aimed at a much bigger audience. So yeah, let's peel back the layers on this, because this decision isn't just about tapping the brakes on the economy. It's a signal. It's a strategic message being broadcast to the rest of the world. And here's the core of that message. The SARB is making a very clear choice. They're prioritizing building this fortress of long-term credibility with global investors over lighting the firecracker of some quick, short-term economic stimulus at home. Okay, so the official reason you'll hear for this decision is, of course, inflation. And look, that's definitely a real concern, but it's only one piece of a much, much larger puzzle. The bank is definitely still seeing some warning lights on its dashboard. You've got core inflation. That's the one that strips out the crazy swings in food and energy, and it's just being really stubborn. On top of that, global financial conditions are tight, and all the geopolitical uncertainty out there, well, it's causing a ton of volatility. So they are not ready to pop the champagne and declare victory just yet. But here's the twist. The real focus is starting to shift. This move to hold rates steady is becoming less about fighting last month's inflation numbers and way more about managing the psychology of global investors. It is all about anchoring their expectations. And that brings us to who they're really talking to with this decision. The audience for this 8.25% isn't just South African households and businesses. Nope. It's the big global capital markets. That's the real target. And this all boils down to one absolutely crucial concept: capital credibility. Just think of it as a country's financial reputation. It's that gut feeling investors have that, yeah, these policymakers are disciplined, they're predictable, and they won't make crazy moves when things get tough. So you basically got two paths on the table. There's the easy path: cut rates, give the economy a quick sugar rush, but you risk things becoming unstable. Or there's the disciplined path, the one they're on now. You hold firm, you prove you're stable, and you attract that serious long-term investment. To put it simply, this whole thing is a strategic trade-off. They are consciously choosing to sacrifice a bit of short-term growth now in order to secure the much bigger prize of long-term capital staying in the country. But let's be honest, a disciplined strategy like this, it doesn't come for free. There's a price to be paid, and you can feel the consequences on the ground right now. And here's what that price looks like. High interest rates mean credit growth is sluggish. It's way tougher for small and medium-sized businesses to get the loans they need to grow. And for regular families, it means spending is recovering at a snail's pace. It's a real squeeze. There's this quote that just perfectly captures the bank's entire philosophy. Macroeconomic stability is a prerequisite for sustainable growth, not a consequence of it. In other words, they believe you have to build that solid, stable foundation first, even if it hurts, before you can even think about building a skyscraper of lasting growth on top of it. And that really clarifies how the SARB sees its job. They're not trying to be the engine of the economy, flooring the gas pedal to create growth. Instead, they see themselves as the anchor, holding the ship steady, so that other things, like smart government policy and private businesses, can be the real engines. All right, so if they're playing this long game, what's the end game? What would it actually take for them to finally say, okay, mission accomplished, and start cutting rates? Well, they've got a very clear checklist. So the path forward is totally conditional. First, they need to see undeniable, sustained proof that inflation has been well and truly beaten. Second, they need to see the government getting its own spending under control. And third, they need to see real, tangible progress on the country's big structural problems, like energy and logistics. Only when all those pieces fall into place can they start to ease up without risking all that credibility they've worked so hard to build. So when you boil it all down, the message for anyone watching South Africa couldn't be clearer. This central bank is laser-focused on the long game. Every single decision they make is being viewed through one lens: building institutional credibility and keeping the currency stable. Everything else comes second. And all of this leaves us with a really fundamental question, one that every country has to grapple with. What is the true job of a central bank? Is it supposed to be an engine, actively trying to create growth? Or is its real purpose to be an anchor, holding firm and providing stability against the inevitable economic storms? The South African Reserve Bank has clearly chosen its side.